Did you know that index fund investors have constantly outperformed actively managed mutual fund investors over the long term? Hi, I'm David. I've been investing in index funds for almost 4 years now. In this video, we'll explore the basics of index fund investing, discuss the good and bad part of this strategy, and provide some tips for you getting started. If you're interested in learning more about how to grow your wealth through index fund investing, make sure to hit the subscribe button and tell your friends about this channel. Here's the question: can you become a millionaire just by investing in index funds? First of all, if you're new to index funds, let me give you a quick breakdown. Index funds are a big basket of stocks. So instead of buying just one share of a company, you can invest in many with less money and you get a big diversification. The most famous one is the S&P 500, which gives you the exposure to, as the name says it, to the 500 biggest publicly shared US companies. The most famous companies included are Apple, Meta, Google, Amazon or Tesla. There are several different types of index funds to choose from, each with its own unique characteristics and risk. There are market index funds, which track a specific market index, such as the S&P 500 as mentioned before, the Dow Jones Industrial Average or the Russell 2000. Then we have sector index funds, which focus on a specific sector of the market, such as healthcare, finance or technology. These funds allow investors to take a more target approach to their investments. Growth index funds and value index funds are another type of index funds to consider. Growth index funds invest in stocks that might go up in price a lot, while value index funds invest in stocks that are undervalued or out of favor with the market. Growth index funds are generally more risky but have the potential for a bigger upside, while value index funds are generally more stable and less volatile. International index funds invest in stocks from countries outside of the United States. These funds offer exposure to a diverse range of markets. Bond index funds invest in a diversified portfolio of bonds rather than stocks. These funds tend to be less risky than stock index funds. Which one you choose is totally up to you, your investment goals, risk tolerance, and overall financial situation. Are you looking more into a big exposure and want to go with a market index like the Russell 2000 or an international index fund to have exposure over the whole world? Or do you want to have a bigger upside and invest into growth index funds? Just a quick reminder, our big goal is to reach 10,000 followers this year, and I can only do this with your help. Hit that subscribe button and send this to your friend if you have learned something so far. So let's take my favorite example, the S&P 500. The S&P 500 has been growing 10% over the last 40 years. What a benchmark. But that doesn't mean that the S&P 500 was growing last year 10%. No, there are years when the S&P 500 had gained 26%, while another year it was 2%. Another year was just maybe minus 70%. Let's just look at the numbers I put together for one of my Instagram posts. Or look at the link I'll leave in the description to check the past performance of the S&P 500. Also remember, these are historical numbers and they cannot predict the future, so invest wisely and accordingly. But if you take the 10% as a fixed number, we can figure out how we can achieve $1 million. If we take $100 and invest them every month in the S&P 500, whether it's going up or down, it will take us 47 years. Whew, that's okay. I mean, better be a millionaire than being broke, but I'll be 75 and I won't be working when I'm 70 for sure. So let's speed this up. Let's take $500 and see what happens when the market returns at 10%. It'll be 29 years till we reach $1 million.
Boring.
Much better. I know that I will be much likely a millionaire before I'm 60 and can lay back. But for the people who know me, that's not my goal. So what happens when we get the big checks and put in $1,000? It will take the compound effect 23 years. And with $2,000, 17 years. Much better and definitely what I'm aiming for. And if you want to play around the numbers, I'll leave the link for an easy calculator in the description, which you can try out after you finish the video. Now we know it's possible to become a millionaire with index funds if history repeats itself, but I'm very optimistic for the long run. But why do I choose to invest in index funds over single stocks? My mentor, Warren Buffett, says 99% of all people should invest into the S&P 500 and don't worry about anything else, and they will build wealth automated. Even Wolf of Wall Street, George Belfort, mentioned it in an interview that you should simply buy the S&P 500 and forget about everything else. I dropped the link in the bottom too, so you can watch it at the end of this video. Next, they have usually a very low expense ratio, such as the S&P 500 by Vanguard, ticker VOO. It has an expense ratio of 0.03%. Most average mutual funds have an expense ratio of between 0.5% and 1%. 1% does not sound a lot, but let me show you that with different numbers. Do you want to pay $10,000 every year? Probably not. And that's what would happen if we achieve the $1 million milestone. It really slows down your growth, and we do not want that. Also, remember that the S&P averaged 10%, and if we compare it to the index fund by Vanguard, it's 33 times more expensive. And last but not least, did you know that index fund investors have constantly outperformed actively managed mutual fund investors over the long term? Wait a minute. So, you telling me index funds are cheaper by having a lower expense ratio and are performing better than most actively managed funds? I mean, do I need to say anything else? I know there are some exceptions like Peter Lynch, but finding these are super hard.
Okay, David, but how do we start?
We need to do some more research. More research? Yes, but it will be worth it. First of all, we need to have an investment account. Could be a tax advantage account like the 401k or an IRA if you live in the States, or an RSP or TFSA if you live in Canada. Please talk to a professional about which option suits you best. Or a brokerage tax account. If we take the S&P 500 for example and want to start investing in an index fund, then we need to check for a provider, because we cannot invest directly into it, but something which mirrors it, an S&P 500 ETF. My advice is to check for the most stable ones and the biggest out there. So, we got ticker SPY, the SPDR S&P 500 ETF Trust, the ticker IVV from iShares Core's S&P 500 ETF, and the ticker VOO, Vanguard S&P 500 ETF. I'm a fan of Jay Bogle, founder of the Vanguard, and some might call him the father of ETFs. So I'm looking at the Vanguard S&P 500 called ticker VOO as mentioned before. It has an expense ratio of 0.03%, the SPY 0.09%, and the IVV 0.03%. All you need to do is to put some money into your account, like a bank account. And as soon you have some money there, you look for the wanted ETF. And then just click on buy, put in the amount you wish to invest, and boom. Maybe 200, maybe 2000, whatever your goal is and you can afford. But remember, investing is not risk-free. There always comes the risk when investing. You could do some mistakes. It's normal. Most beginners lost some money in the stock market. Some learn by it. I lost some money too when I bought my first Tesla stock, and I hope you will learn from it. Also lost some money with stop loss. Don't play around with it. So we already mentioned the benefits like annual return of 10% of the S&P 500, really low expense ratio, diversification, and convenience, because if you want to automate it with all the ups and downs, you can become, with patience, a millionaire on autopilot. But what are the drawbacks of it? You will never outperform the market, but the hard truth is 90% of all professionals are not capable of doing it over a long period, so why should you try it? Second, you have no flexibility. You will always just be able to buy what's in the funds and cannot cut out specific losers like Facebook, Meta as example. Most people I know don't use Facebook anymore, so it really comes to the door to companies like Instagram, as it seems that Zuckerberg's metaverse is not in reach yet. And what you have to learn is stocks and markets don't always go up. They can go down too, and you have to live with it. You just need to be assured that the American market will go up again someday like it always did in the past. You need to trust your investment. If you can't see your investment losing 50% and staying cool, you shouldn't be investing in the stock market, because that's when you lose most of the money. If this was helpful, please remember to subscribe and check out my other videos to learn more about index funds, investing and personal finance. And thank you so much for sticking to the end. If you have any more questions, ask in the comments so that I can answer them all in a future video. Here might be another video which you might be interested in. See you next time.